SK Hynix hit the Nasdaq today, listing at $149 and immediately opening at $170, a clean 14% pop right out of the gate. But look at this price chart. SpaceX did the exact same thing, popping past $200 on day one before violently collapsing days later. The question is whether SK Hynix is destined for that exact same crash, or if its business makes it immune. Here is the market's reality. In the first few days of trading, retail hype operates completely independently of a company's actual fundamental value. To avoid buying at the absolute peak, we have to strip away the day one headlines and compare the structural foundations and the valuation mechanics of these two mega IPOs. This matrix charts exactly where the hype separates from the math, starting with the gap between what these companies are valued at and what they actually earn. SpaceX went public trading near 100 times its trailing revenue. That price tag was built entirely on the unproven promise of future deep space logistics and Mars missions, not current cash flow. Paying a massive premium for a monopoly without cash flow leaves you exposed. The moment retail enthusiasm cools off, the stock loses its only support system and corrects hard. SK Hynix enters the market with a completely different profile. They boast 70% operating margins and are actively deploying $4 billion into a massive U.S. manufacturing expansion. That profitability gives investors a much safer earnings floor. However, buyers are entering a cyclical hardware market at peak AI exuberance. When the hardware cycle inevitably turns downward, this stock will still take a heavy beating. SpaceX's core growth driver requires the iterative testing and proving of next-generation technology. Technological progress is messy and nonlinear. When public testing failures happen, investors are forced to hold their positions through extreme volatility and sudden, sharp sell-offs. SK Hynix operates in the immediate present. Look closely at these silicon wafers. This is high-bandwidth memory, and the AI industry cannot run current models without it. They have already booked out their production capacity against a $160 billion institutional demand pipeline. The question of whether the technology works has already been answered with purchase orders. But by removing that technological risk, investors are taking on capital expenditure risk. If the software side of AI fails to generate enough revenue to justify all this expensive data center hardware by 2026, SK Hynix's demand will evaporate. You are trading tech risk for market timing risk. Beyond the business models, there is a mechanical structure to mega IPOs that can destroy your portfolio regardless of how good the company is. Look at this diagram. Massive IPOs intentionally constrain the supply of available shares through highly restrictive public floats and insider lockup periods. That artificial scarcity collides directly with retail fear of missing out. The result is a violent upward squeeze, driving the stock price to completely unsustainable levels during week one. Then the lockup periods expire, a flood of insider supply hits the open market, and the price collapses under the sheer weight of the available shares. Buying on day one means you are risking your principal directly against an impending wave of insider selling pressure. The SpaceX rollover was a failure of valuation mechanics, not a failure of the company itself. Hype simply does not care about business fundamentals. While SK Hynix is a highly profitable, mature business, it is subject to the exact same IPO gravity. This decision tree maps out how you should handle this. Let's start with the day one speculator. If you're a momentum trader, wait out the initial price discovery phase. Fighting artificial float constraints is a losing battle. If you fall into the fundamentals optimizer profile, SK Hynix offers a highly rational play on AI durability, provided you can stomach paying the initial IPO premium. And if you are a thematic believer seeking exposure to generational trends like SpaceX, you must use dollar cost averaging and maintain an iron stomach for explosive volatility. A great company is only a great investment if you buy it at a logical price. To succeed here, you have to watch the mechanics of the first week instead of buying the headlines of the first day.